You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend and portfolio manager at Simplify, as well as the head of trading, Shailesh Gupta. So Shailesh is a very talented vol and VIX trader. So it's going to be very interesting to get your thoughts on trading vol in this environment, as well as just general vol strategies, your background, etc. So Shailesh, thank you so much for being on the podcast. It's awesome to have you on.
Thanks, Sri, and thanks for those kind words. I won't really say expert or anything, but as my Twitter handle says, like VIX is something you can only observe, like from a 30,000 feet what's going on. Nobody can really predict what the VIX is going to do next, right? So
absolutely, and I mean, after all, you are so on Twitter your handle is at VIX_sage, so you are the sage of the VIX. So
so one can only meditate about VIX rather trying to predict where it's going to go up or down. Right. So you asked me about my background and how I got to looking at VIX so closely over the last few years.
Yep.
Is I started my undergrad was in engineering, although it was more of a choice between math versus biology. The math students in India typically end up doing engineering, and that's what I was doing. However, while doing engineering, I figured the most exciting class was optimization, where profit maximization was what was something which got me excited. So naturally I had to pursue career in finance, given that even while doing engineering, my favorite courses were more economics related. So started working in finance in India after doing my MBA, but mostly it was credit analysis work. However, I was more interested in the option theory and how the pricing of the options are done, what's the theory behind it, kind of a thing. So I decided to do financial math from University of Chicago. It was a brand new program. And before that program, typically rocket scientists would do quantitative finance on Wall Street. So I said, okay, let's see what this is all about. And that's where I got into trading derivatives and ended up getting a job at PIMCO, trading derivatives. And this was early 2000. And at that time, one of the primary strategies run at PIMCO was to monetize the yield curve premium. The yield curve premium at that time used to be more than 3 or 4 times what it was today. And typically the front end moves based on what the Fed is doing, and the long end would have a lot of risk premium. So how do you monetize the risk premium while neutralizing the Fed risk, so to say? So a lot of options, swaptions, futures, those kind of trades, analysis, development of those strategies, goes in that kind of a work. And, did that for several years, 10 years to be exact. And, PIMCO won the Fixed Income Manager of the Decade award. And, PIMCO Fixed Income Shop, it would seem that, you buy credit bonds and that's how, PIMCO makes money, but a lot goes behind the scene. And PIMCO is one of the real money manager which trades like a hedge fund in terms of swaps and swaptions and futures. So it's sort of one of the Wall Street people would tell me it's like a mother of all hedge funds. So we pretty much trade like hedge funds, but in a more unlevered way, taking more moderate risk with the goal of outperforming the benchmark by 1%. Rather than trying to make 10% of alpha in a hedge fund. So, when you run risk on an unlevered in a measured way, you get much better information ratio or a risk reward, trade-off, so to say.
Yep.
And that's what I try to do in the hedge fund world over the years, with a lot of focus on VIX, because VIX move around quite a lot, and hedge funds are very interested in that kind of product. It seems that there's a lot of mean reversion in VIX, so there is a lot of predictability. VIX is low, you buy VIX. VIX is high, sell VIX. Seems like easy: buy low, sell high, make money. But it is not that simple.
Right.
And what I realized doing this was, like VIX trades very much like an interest rate curve. Like 20 years ago, the yield curve used to have premium. Similarly, VIX curve now, it has that kind of premium. There's a risk of VIX going up, and the distribution sort of log normal, right? Because VIX cannot go negative, or it can't get close to zero, but it can go very high. And we have seen during COVID, it went as high as 80, currently trading around 25 or so, right? So similarly, interest rates, although we have seen interest rates around the world going less than zero, but still zero is kind of a bound that interest rates can't go significantly below zero, but they can go much higher, and rapidly they can go higher, right? So, the VIX curve very much trades like an interest rate curve,
Yeah.
but sort of on a warp speed, in the sense that what happens on an interest rate curve on a 30-year horizon can happen in VIX curve over a 6-month horizon, kind of a thing. So it's like, it's much more, fast pace, more exciting, and so on and so forth. And, what have you seen, people interested, people that you talk to, how do people view VIX?
People typically, view the VIX as some sort of a fear gauge. Especially if you're not well versed within, if you're not just a volatility trader. So typically your view of the VIX is, okay, VIX is going up, people are getting more scared, or VIX is going up, therefore implied volatility on on S&P options is going up. Or if VIX is going down, then you can buy you can buy very cheap, say, put options, or very cheap call options on the VIX, and then you can make that sort of a hedge position. And that's sort of how I've seen people think about the VIX. But the way you sort of describe it as an interest rate curve is, or as a sort of compressed interest rate curve, where the time horizon of the VIX behavior is compressed, is I think very fascinating.
Yeah, I mean, as you rightly pointed out, VIX as a measure, one can take a view looking at VIX whether to buy or sell, options or not. So it's a measure where the options are trading. Implied volatility obviously is the key variable to go in the pricing of the option. When the VIX is high, options are more expensive or rich, and when the VIX is low, options are cheap or inexpensive. So one can definitely take a view on buying or selling options based on VIX. But if somebody has to bet on whether VIX is going up and down, I think a lot of people try to take a view on the market based on where the VIX is trading.
Right.
But I would argue that although the theory suggests that VIX should determine the value of the market, VIX is high, the equity should be worth less, and VIX is low, equity should be worth high. But the VIX market is much more shallow as compared to the equity market. They are highly inversely correlated. So what happens in the equity market impacts the VIX much more than what happens in VIX. In impacting the equity market. I would say the ratio would be like 100:1. 100 trading days, you would have, S&P impacting the VIX.
Right.
And 1 out of 100 days, you would say, okay, something happening in the VIX could be impacting, the market. So, it's a chicken and egg kind of a thing, which is driving what. But the important thing is to understand that VIX is highly negatively correlated with the equity market. So if you want to short the market, you can short the market, or you can buy VIX. If you want to buy the market, on the other side, you can buy equity ETFs or futures, or on the other side, you can sell VIX. It's kind of, very close to 1:1 relationship. So if one
Right.
has to take, a directional short-term view, one might as well take it in the most liquid product out there. But what is, VIX is, other aspect of VIX is that it is used as a hedge. That people who have a structural long position in equity or the risk assets like credit or value stocks or even growth stocks for that matter. But if you have a long equity factor risk exposure, then VIX can be and is used as a hedge.
Uh-huh.
So on that perspective, short VIX should be viewed as an alternative to buying equities. So
Right.
there would be some environment in the market where the shorting VIX is better than being long equities. However, the distribution, the betas keep on changing, and so on and so forth. One need to take that into perspective. And the other important part in VIX is that VIX is a lot more volatile than the equity market. So
Right.
close to 5 to 6 times. VIX can be 5 to 6 times more volatile than the equity market. So effectively, a trade in VIX for the same notional is effectively highly levered S&P position.
Yeah.
So, like from shorting VIX, people remember the XIV episode where the ETF lost almost all their capital, more than 90% of the capital, in one day. So,
Yeah.
like the VIX portfolio or, should be viewed like a futures account. That, you have a futures account, it's sort of on margin. That, one can lose all the capital if one doesn't put the appropriate amount of risk.
Yeah.
On that account, I would like to show this chart. Can I share my
Yeah,
screen?
yeah, absolutely.
So like in this chart, you see the rolling 12 month returns on the green line is the equity market S&P 500, and the red line is short VIX. This is it's not very visible in this chart, but when one moderate it to more like 25%, then you can see that the equity market and short VIX go up and down. But the red line is the XIV, the famous XIV, that it lost close to 100%. During the Volmageddon when VIX spiked and it lost most of the capital. But before that, it was a very popular trade, making more than 200% for a long period of time. So it's like if you have an investment where you can double or triple your money in a year, that kind of investment one should expect that one can lose all your capital, in a short period of time. That not just COVID, not just Volmageddon. You see that even during COVID times, if that product was out there, it would have lost a large part of the capital, right? So as I mentioned, VIX is 5 times or so more volatile than the equity market. So effectively, a VIX position is 5 or 6 times levered.
Yep.
So if you have that kind of a leverage, then obviously one can have a large amount of drawdown. So it's very important that one take a measured amount of risk, and any product which is designed, to buy or sell VIX, the exposure should be carefully monitored, measured, and the investment objectives should be matched with the amount of risk which is being taken. That being said, that question is, how do you monetize these high level returns with avoiding this large level of drawdown? That as we discussed, the VIX is close to five times more volatile. It's logical that something more like 20-25% VIX, short VIX, should trade, should have the risk in line with the equity market. So, that's why we believe that, that's the right amount of exposure one should take to monetize the volatility risk premium that you mentioned. Volatility has a lot of risk premium, especially in this environment after COVID, that VIX is elevated, curve is steep, so you're getting paid to take, risk. And in an environment with both, equities and bonds struggling to make any returns, short VIX is making money. Question is how much risk you want to take without, losing your capital.
Mm-hmm. Yep, absolutely. I think, one of the interesting things that you mentioned was that so short VIX was in a way sort of an alternative to being long beta or long the S&P 500. How could what would you look at to tell, what the preferred trade would be? Would you rather go long equities or would you just go short VIX? So, how would you go about figuring that out?
Yeah, I mean, let me show a Bloomberg chart, to take a view on that. A key determinant. Okay, let me just pull up another VIX chart. You see, typically VIX curve has a upward, sloping curve that if spot VIX is trading 25, 1 month future, 2 month future, and so on and so forth, trade at a much higher price.
Right.
So the reason for that is that, somebody, like if VIX, how do I say this?
The VIX is in.
If VIX had no premium, then VIX is sort of like a free option. VIX is trading at 25, it can't really go too much, but it can go, very high in a crisis situation. If there was no premium, then one would always want to be, long VIX. So this demand for VIX to hedge long equity exposure, what it does, it transports the equity risk premium onto the volatility curve. That in a steady state over long horizons, if you're expecting equity market to make 10% per year, if you're expecting equity markets to grow at 10% per year over a very long horizon, 20, 30 years, short VIX should have the same amount of premium, right? So otherwise there's an arbitrage, otherwise there's free money. And you can just buy equities and buy VIX against it, and you make more on an equity. And then if you don't have to pay anything on VIX, then you can run a hedge fund and become a billionaire very quickly, right? You can make risk-free returns. So that is a primary reason that short VIX should, on an average, make the same amount of money as the equity market.
Right.
But the regimes changes. Like, for example, before Volmageddon, before in 2017 or so, that VIX was a popular strategy. So equity market was growing at 15-20% per year. For same amount of risk, VIX was also making the same amount of money. But it was an extremely popular strategy at that time. So it had extra amount of risk. It was making same amount of money, but it has extra risk. That being a consensus trade, being a less liquid market in the equities. So when people start to unwind those positions, that position can lose a lot of money. As compared to that, in the current environment, VIX is a very unpopular strategy, or at least short VIX is a very unpopular strategy. It's a dirty word. Nobody wants to, put in a short VIX position. That VIX can spike and I can lose a lot of money. And even the banks find, the risk management teams don't get enough. They charge extra margin and so on and so forth. So this risk aversion, causes extra risk premium on the VIX curve. And that's what I want to show in the next chart, is that what we have on the x-axis is just VIX, and what is y-axis is the curve premium that we saw here. It is in percentage terms. So like, for example, the spread between the second month and the first month is around 1 point, so for per month. So that is around 12, 13 points for the year. So that is around 50% yield. And what we see that this 50% yield, is is the column Y that we have over here. So
Okay.
this 50% yield is corresponding to VIX at around 2025, 26.
Okay.
Right? And this chart is over last 10 years. So at current level of VIX, the fair value of the yield is more like 18%. So you see the yield on the VIX curve is several times the fair value. And there are two reasons for that. One, after the Volmageddon, the people don't want to short VIX. So although VIX is above average as compared to historical levels, so it looks like a good level to be short VIX, but still there is more demand to buy VIX than to short VIX, which gets transmitted onto the VIX curve, which shows up at this red dot to be more than what the fair value is, so to say. So this is pretty much the framework that I use, and I haven't seen this in any published research, so to say. It's a very simple analysis, but to me, it seems for same amount of risk, one can, same amount of equity market risk, one can generate better than equity market returns. And if one calibrates right, so effectively one can, design a strategy which has less than market risk, but more than market return. And
Okay.
that's pretty much the holy grail of investing, right? So you want to take less the risk in the market and
And
generate more
more than the
return
rest
than
of the market. Absolutely. I think one of the things that you mentioned when you showed, so the first chart that you showed was a chart of the term structure of the VIX. So essentially, for anyone listening who may not be familiar, so what that means is Shailesh basically showed what the VIX futures curve looks like, and you said that a flat curve is the same thing as having a free option on the VIX. So could you explain, how that works? So why does a flat curve mean that there's a free option, the VIX?
So let me pull up another chart. Let's see what the VIX history is. Right. So this is the history of VIX, and this is the history of VIX over last 5 years. VIX is around 26, right? If I don't know anything else, if I have to bet on VIX, do I want to buy VIX at 25 or do I want to sell it? If everything else is same, if I buy VIX here, I can lose 10 points, but I can make, 50 points.
Yeah.
Right. So you see the asymmetric risk, okay, I can put in a small amount of position. Okay, it goes up and down, 5-10 points, so to say. Suppose I bet $1 per VIX or $1,000 per VIX. One futures contract is $1,000 per point of VIX. So if there was no cost, then I just want to buy VIX over here, right? So, okay, especially that it is negatively correlated, the spike happens when the market crashes, right? So effectively buying VIX is as if buying an option, right? So there's a large payoff, in case market crashes. Otherwise, just VIX keeps on trading between 20 and 30.
Yeah.
Right. So that's why, buying VIX is like buying an option, and selling VIX is like selling an option.
Yep. And so essentially, when what you're saying is, so when the VIX curve is flat, there is no volatility risk premium being placed in. And so in a way, you have the opportunity to buy the VIX. So where does the free optionality come from? Is it just the fact that as you showed, so you could potentially lose, say, maybe a little bit, but then you could potentially say it goes from, say, 20 to 50 or 20.
That's right. A different way to look at it is, okay, this screen is just falling. Okay, let me just make it smaller. Okay, so right. So if there was no term structure and we cannot buy or sell VIX, we can only agree to have a future bet, which is a futures contract. In 1 month's time, you and I bet. Suppose you want to sell VIX and I want to buy VIX. Suppose I want to buy VIX and you have to give me a price. Today, VIX is trading at 26 and a half. Right?
Yeah.
So you'll be happy to sell me VIX at something like 27, right? So you don't know where the market is going up or down. So expected value of VIX in 1 month's time is say 27, right? So you would be happy to sell VIX to me at 27 because, okay, you have expected profit of 50 cents, right? But at 27, the demand for VIX would be a lot higher because, a lot more people would think that there is a optionality of a large payoff,
Yeah.
from buying the VIX. So that's what demand for VIX 1 month from now should settle, a little higher than 27, right? So if you look at the futures curve, so that's why you see, for a spot level, this is 1 day old. See the live market here. So live VIX is here. So you see, 1 month VIX is more than the spot VIX, right? So this is a demand and supply. So demand for VIX, if there was no premium, the demand for VIX would be a lot higher than the supply at current level of VIX. If the forward price is same as the spot, the demand would be much higher. So that demand supply imbalance would shift the forward prices to be higher. Similarly, if the forward price is higher, the second month should be even higher. Otherwise, one can just, buy this and sell this to get a free optionality, so to say, right? So that's how the premium get priced in.
Okay. Okay. Awesome. One more thing when it comes to when it comes to this idea of, so as you mentioned, buying the VIX is similar to buying the option because your profile is essentially long volatility. And then on the other hand, selling the VIX is somewhat similar to selling an option because selling an option and selling the VIX both have a short vega or a short volatility profile. How do you choose? So essentially what the VIX, at least to most people, is showing, or the general idea of the VIX is to sort of show the level of volatility for the S&P 500. So what different? So when will you take a position, say long or short S&P volatility versus just trading VIX futures? What's the difference between expressing your view in both those markets? Because essentially you could say buy or sell a straddle, and you would essentially be taking a similar view to being long or short the VIX. So what are the considerations that go into which market that trade is expressed in?
Yeah, so like the short volatility is often, considered synonymous with shorting options, right? But there is more to it. That volatility is just one component which goes, into the option. Depending on call and put, assume you make it delta neutral. So yes, volatility goes up, the price of the option goes up, and volatility goes down, the price of option goes down. So short volatility is often known, as the short option trade. But that is very different from being short volatility. Although both have optionality, but VIX is a variable, which has a premium in it. So I would say VIX is more like a credit spread. That credit spreads, suppose a high yield credit spread would trade at around 300 basis points, forever, then suddenly it can become 1500 basis points.
Yeah.
Right. So VIX is sort of like a credit security. That if VIX stays at the same level, then short VIX keeps collecting the premium. And if you're long a high yield bond, and the spread remains unchanged, you just keep collecting the yield. So actually I can show you a chart on that. So you would,
There's a chart for everything.
I mean, there has to be a chart for everything. A picture is worth 1,000 words, right? So this is, see all the credit spreads and the VIX. The white line is the VIX future actually. And this is, I think, the long-dated future. We can change it to the short-dated future as well. But you see, the VIX and credit spreads pretty much go hand in hand. But most of last 2 years after COVID, the credit spreads normalized, but the VIX is still elevated, right? So VIX still has value or had value. That's why you see over last 1 or 2 years, for same amount of risk, short VIX has outperformed the credit. Short VIX has made some money, but credit securities have lost money because the spreads have, gone up, so to say. So right now, still, VIX is still better value as compared to the investment grade or high yield credit, so to say. But the point is that if VIX remains unchanged, then and credit spreads remain unchanged, the high yield securities collect the coupon or the premium or the yield, the VIX collects the roll down yield. Right, so that's why it's important to view the yield in the VIX curve, which we say is 50%, right? So it's 50% for 25, 26 level of VIX. What this means is, but again, remember this level of yield is for a levered position. This is for a full position in VIX. So if you have a 25% exposure, so then you'll have close to 15% yield. Right. So, if you have an equity with a 15% yield, that's a fantastic investment, right? So like, okay, market goes up or down, I don't care. I'm getting my 15%, right? So that's what VIX is. That's what shorting VIX is if you moderate the exposure. On that note, I would like to show, one table, but okay, so let me show you this quickly. So this table, we see the S&P has, volatility of 16%. And it has tail risk, which I define as probability of loss over 1 month, 1% probability, or basically worst 1 month out of 100 months. That is my definition of tail risk here, is say 18% or something like what happened in COVID, right? The COVID March to 2020, equity market dropped 20% or so. So, you see VIX is 5 to 6 times, more volatile, even more than that. But that volatility can be reduced by you can moderate the VIX exposure to 50% VIX. It reduces the volatility to a large extent, right? But still, it is much more volatile. And in fact, you would see the chart of S&P versus short 25% VIX is, short 25% VIX, the chart would be very similar to like a 2x S&P. And in fact, if you want, we can try to model it up here, that SPX index. Do you know the ticker for can we use a ticker for other funds? Like two times levered S&P?
I think so. Yes, I think we can. Yeah. As long as it's not a ETF, we should be okay.
Right. So, I mean, like, can we use SPY?
You can, yeah.
Okay. So we have SPY, which is the S&P 500. So SSO is 2 times levered S&P. Right?
Okay. So
right.
SSO, okay, that's the orange line and the white. Okay.
Yeah, so if you look at over last 3 years. Right, so the white line is S&P and the gold line is 2 times levered, right? And if you use a 50% short VIX, so SPX.
Is it the last one? The half X inverse daily?
That's right. You see? 50% short VIX is very similar to as if long 2 times S&P. Right? So that's a lever. So we don't have an index for 25% VIX, but you can find on our website, a bunch of detailed analysis on 25% short VIX on simplify.us. But you'll see that 25% short VIX should be closer to what the S&P market risk is.
Okay. Okay.
Does that make sense?
Yeah. And then, the other part of, the simplify approach has been, the other part of the simplify approach has been, as you mentioned, 50% is roughly 2x and 25% is roughly 1x. So the other part has been hedging out this position. So how do you think about hedging out a short VIX position? So one, how do you think about whether to use options or futures, and how do you decide, what sort of tenor, what strike, what price to buy?
Right. So, we discussed that VIX is a log normal distribution. Right. So just like interest rate, that it can't go too low, but it can go very high. Yeah. Right. So, and we want to have S&P like exposure. So we don't want those big spikes, or big spikes would cause a big loss. Right. So that's why we talk about sort of a capped variance. concept that Mike Green has talked about, is that we want to be short VIX, because it gives extreme amount of yield for S&P level of exposure, but we don't want to take the tail risk. So curtail the tail risk by buying out of the money options on VIX or VIX related or the other ETFs, so and so forth. So it's effectively what happens is when you buy these tail risk option out of the money options, you make the log normal distribution to be close to normal, close to something closer to what S&P distribution is. So that's why you would find that with 25% short VIX with options, can make as much as equity market return as in 2020, last year, but much less drawdown in this year. The first half of the year the market was down 20%, but showing 25% short VIX with option protection was down much less.
Got it. And so essentially, when you add in the options hedge, then what ends up happening is the behavior becomes even closer to that.
Right. So it's like you cannot hedge all the risk. If you hedge all the risk, then you won't have any return left, right? So question is, what's a good risk to have versus what the risk that you want to eliminate? That would you prefer to have an investment which goes up and down, like the market, but when the market crashes, it crashes less? Or would you prefer an investment which moves much less as compared to the market, but when the market drops, it drops more than the market, or same level of the market, right? So question is, do you want at the money volatility, or do you want out of the money volatility? Right. So we don't mind being short at the money volatility, but we don't want to be short out of the money volatility, right? So market goes up and down 1-2%, portfolio is down, up 1 or 2%, no big deal, right? But you don't want to be down 20-30%, right? So that's why you hedge those tail risk.
Yep.
Buy out of the money options.
Yeah, and so in a way, what so you want to be short at the money volatility, and then you want to have a little bit of long out of the money volatility in order
Right.
to.
So if you want to monetize the VIX premium, VIX goes up and down with the market. So you want to monetize the premium from that volatility. So you short VIX, which is sort of like shorting at the money, right? So as if this is equivalent to shorting at the money option. But VIX spikes, you don't want to take that big loss, right? So you are happy VIX stays, between 20-30, keep collecting the premium. But VIX spikes over 50, you don't want that loss, right? So you hedge that using options.
Yeah. Okay, now that's fair. And so you again, you also said that as you mentioned, if you hedge out all the risk, you're not at least according to general finance theory, with no arbitrage, you're not going to have any return left. And so if you hedge out all the risk, if you're taking on no risk, you cannot get compensated for that. So as a corollary to that, you're not going to have any return. How are you going? How do you think about how much risk to hedge, or how much of your VIX position you want to hedge?
How much VIX position we want to hedge?
Or do you typically hedge the entire thing?
Right. So the way I think about risk and the return is you can guesstimate what the return is based on what is priced in today, right? But the risk one should view based on what we have seen in the past. How the market behaved during COVID, how the market behaved during Volmageddon, how the market behaved in crisis before that.
Okay.
So you do your sensitivity analysis, back test to gauge the risk on a strategy or a product based on history. But forward returns one should gauge based on what is priced in. I showed you this chart. For same level of VIX curve, if the yield was 18%, then one should expect historical level of returns for current level of VIX, right? But the yield currently is priced in much higher, so you should expect much higher returns.
Okay, and then so similarly, if the, let's say, the current, instead of the red star being above the red line, so essentially instead of the current return being higher than the historical average, let's say it was below the historical average. So what would be a strategy in that situation?
Yeah, so important thing to understand in this chart is that the VIX versus the yield relationship is very stable over a short period of time. So if I do a 6-month horizon on a daily basis, on a week, you see this chart is much more together, right? The variation around the chart is.
Yeah.
So so yield versus, VIX goes higher, yield goes lower. VIX goes lower, yield goes higher. So these are two engines of generating return in a short VIX strategy, or or the cost of the hedge in a long VIX strategy, right? So but so more important thing is to understand what would be the average, what you're expecting the VIX to be, going forward. If you assume VIX would be moving towards its long-term average of say 20, right? The question is, what do you expect the average yield to be in that environment, right? So if the VIX is here and VIX is going to 20, the yield would be somewhere in this region, so to say, right? And how does that yield compare to what it has been historically, so to say, right? So that's where you look at more, long-term chart, something like the monthly chart over last 10 years.
Yeah.
Comes back to this. So like this regime is particularly good, for shorting VIX, because the curve is offering, more than historical level of premium for the current level of VIX. Other way to think about this is that, when the VIX spikes, you see most of the time the spikes come from a low level of VIX. When the VIX is elevated, the risk of spikes is sort of lower. The way I think about that is that, when the ocean is calm and you drop a big stone, it makes a big splash.
Yeah.
Right. But, you're sailing in the market, there are big tides, ocean is up and down, right? And you drop a big stone, nobody even notice what happened. Kind of thing. So like, any kind of external shock to the system, would have a bigger impact when the VIX is lower. And one can actually see this when one put on a regression of VIX changes versus S&P changes. That the beta or the risk to S&P is lower when the VIX is higher, and it is high when the VIX is very low. VIX goes to 10 as during Volmageddon, and even a 4% spike caused VIX to double up, so to say. But for here, what we noticed, even during COVID time, that after the first shock, the subsequent shocks, the impact was much lower than what it was, during Volmageddon, because VIX had already elevated. So it's a question of the amount of shock, the size of the shock when the VIX is low causes the biggest impact.
Yep.
So
Absolutely.
effectively, what that means is, when the VIX is high, the risk is low, but the yield is high. So currently, VIX is above average. So risk of VIX spiking is below average. Risk is below average, but the return potential is above average. That's how you can, generate higher than market returns with lower than market risk, right?
Yep. So, essentially, when a layperson looks at this, so their initial thinking would be, so let's say, if you got to short the VIX at 20 versus getting to short the VIX at say 50, you would naturally assume that 50 is a higher price, therefore you'd get a higher yield for it. But then your chart shows the opposite, that as the VIX is higher, the yield that you can potentially get from it is lower. So is that primarily because as the VIX rises, the curve is also potentially thrown into backwardation? Is that sort of how it works? What were the dynamics of what happened during COVID?
Right. So as we saw in the short term over last 6 months or so, the yield versus the VIX level is very, very, very predictable, so to say. VIX goes higher, the yield would be less, so to say. But a short-term trade or a position one takes, one should look at the futures curve. What is priced in the futures versus what your expectation of VIX, kind of a thing. However, a long-term investor should view VIX as an sort of an alternative to a equity risk, either through equities or a high risk credit securities, basically equity factor risk. So VIX should be sort of it's like the decision should be, should I invest in tech, or should I invest in healthcare, or should I invest in energy, or should I invest in short VIX? So short VIX is a sector allocation decision rather than the directional decisions. The directional decision, which is a short-term decision, should be based on what is priced in the futures curve. So VIX is at 50 and the forward VIX is at 40. But if you are expecting VIX to go down to 30, so then that's a trading position. But a long-term investor should look at the relationship, whether the yield versus the risk is above average or below average as compared to historical level, right? So if nothing happens, we know the yield in the VIX is close to 15% per unit of S&P level of risk. Are you expecting equity market to make more than 15% or less than 15%?
Yeah.
Right. So if you are expecting equity market to make more than 15%, then you should be long equities. If you are expecting equity markets to make, single digit, 5 to 10%, then one should short VIX instead. So if somebody is in 10 to 15%, then one is indifferent. Whatever one, anybody can win this dogfight. But I'm confident in an environment where equity market is making low single digits, then short VIX for same amount of risk, the lever down 20-25% exposure would outperform the equity market.
Awesome. The other thing that comes along with these strategies is, so people typically think of something like the VRP monetization is collecting pennies in front of the steamroller, to use the old adage. And so what people also compare this to is, say if you have a carry trade, let's say one of the biggest or one of the more famous ones was long Aussie dollar, short Japanese yen. And essentially the trade was such as, especially post the financial crisis, what you ended up having was Japan would have negative interest rates, and then Australia, being a commodity exporter, being more susceptible to inflation, so that would have higher interest rates, and so people would try to monetize the spread. And what ended up happening was, so at least with historical experience and data, what we're able to observe is that the relationship between the two is, or the relationship or the law or like a carry trade strategy is essentially a short gamma position, because when shit hits the fan, what ends up happening is you start to see these trades blow up. You started to see Russia blow up in the in the late 1990s. You start to see emerging markets blow up, say during COVID, for example. And so would you argue that this has a similar short gamma profile? And then too, in these alternative ideas, say carry trades, etc. Is this similar opportunity present where you can harvest some sort of a risk premium?
We have a nice blog on carry strategies on our website, simplify.us, and that shows that basically there are two kinds of carry trades, right? So one set of carry trades are correlated with the equity market. So you can say short VIX is a carry trade, long credit is a carry trade, short options is a carry trade. And on the other side, long treasuries is also a carry trade, because typically the long dated bonds have a higher yield than short dated bonds, right? So the treasuries also have a carry. So the treasury versus equity correlation diversification can help improve the information ratio of the portfolio. But even within the equity market related carry trades, there are two kinds of carry trades. One is through the optionality, and one is through the risk market, credit market, or I would say VIX is closer to credit markets rather than being short options.
Okay.
One can be one can be short VIX and long options. Right, so it's like a VIX position is a position on the volatility, and you can still buy options buying in spite of being short VIX. If you understand that, one can buy options on credit, right? So are you short gamma or long gamma, right? It's hard to say. It's sort of short at the money and long out of the money, that kind of a discussion that that we had. So I would say short VIX is more like an asset, while short options is more like a strategy. So here what we are trying to do is trying to figure, VIX is used as a hedge to hedge an asset, a long equity asset, right? So long equity market risk. So that risk gets monetized or transformed onto the VIX. How can we monetize? How can we make an asset out of a short VIX strategy? right? So, the example that you mentioned, a lot of time what happens in carry trades is carry trades become consensus carry trades. When it looks like free money or money lying on the floor, that everybody jumps towards that. So the problem with the carry trade is when they become consensus trades.
Yeah.
When it becomes a consensus carry trade, and then it becomes like a bunch of people watching a movie. Somebody calls fire, everybody wants to run out at the same time, and that's when the carry trades blow up. That's true for any strategy, being carry or not carry for that matter, that one should avoid being in consensus trade to avoid large risk. And that's exactly was the situation in 2017, 2018. How popular was short wick strategy at that time, that every hedge fund on the planet
XIV.
wanted to short wicks, right? So it's like somebody who doesn't understand a bit about wicks wanted to short wicks because it was making 200% per year, right? It's like crypto on turbocharge, right? Crypto,
Yep.
so to say, right? So that's the important part, to measure the position and look at what everybody else is holding.
100%. Yeah, I completely agree. And I think, I think that comparison that you made, this consensus carry trade where everyone is in on the same strategy or in on the same trade. And, that typically helps point out, that's usually a good indicator of when you want to get out. One of the other things is, so, most people typically, when it comes to their portfolios, they tend to be long equities, and these equities typically tend to be, risk on type equities. As the market goes up, equities likely go up, either as much as the market, maybe a little more than the market, maybe a little bit less. And then on the way down, typically follows the market, equities decline. Where I'm interested is when it comes to looking at, say, VIX, VVIX, etc., any sort of VIX derivative. So is there any way, or are there any signals that you've noticed that can sort of, tell you beforehand that, market stress may be approaching?
I would
Have you been able
say,
to look at indicators, etc., for that?
yeah, I mean, typically when the VIX is high, the VVIX, the volatility of VIX should be high, right? So, however, over last few months, we have seen that the VIX is elevated, but the VVIX has come down. That means the tail risk of the VIX is sort of underpriced. So market is expecting market to continue to be volatile. However, the probability of the spike, which is implied in the market in the VVIX, which has reduced. So, there could be an opportunity, that when the VVIX has declined, so maybe there is a potential for, in case there is a large event, the VIX could spike. So, VIX would continue to be volatile. You monetize that premium through short VIX, but you should, buy out of the money options, to take advantage of low VVIX. So, you take what the market is giving you, and you measure your risk based on your risk profile, and as long as you moderate the risk, you should be ahead of the market.
Okay, got it. And so, as long as you moderate your risk, as long as you watch your risk, you should be ahead of the market. And one of the other things is, so XIV. So let's say we have another XIV type product where the strategy is 100% short fix. I think the difference would be, if you have 100% exposure to a 25% short fixed product as opposed to a 25% exposure to 100% short fixed product. I think that actually makes a difference mathematically, does it not?
I mean, it also depends on the strategy. That short products have have the rebalancing cost, right? So when you're short 100%, you have a large rebalancing cost. Rebalancing cost is, because you're short, your exposure changes such that you end up buying high and selling low on a daily basis, right? So when your exposure is low, say 25%, you can actually have a band around it. So if you have, you are allowed to have an exposure 20 to 30%, then you don't have to do, the buy high, sell low on a daily basis. That's why having a unlevered portfolio, you have an advantage for a long-term growth perspective. as compared to, I would say 100% short wicks or 50% short wicks are more trading tool, just like a levered S&P product, right? So if you have 2x S&P or 4x S&P, those are not, one would not recommend that as long-term strategies. They're more like, okay, you have a 1 day or a 2 day view, on the market. So you just want to, put up a levered position.
Right.
Right. So those are trading tools versus unlevered position is more like a long-term investment.
Yep. I got that. And so, as you made that distinction when it comes to options versus a responsible short fixed product, that would be sort of an asset or a strategic position versus a strategy or a tactical position, so to say. Awesome. No, Shailesh, with that, thank you so much for being on the podcast. But before I let you go, could you tell the audience more about where they can find you and more of your work, especially on the Simplify website?
Yeah, so look at simplify.us, and we have some blogs on VEX and some blogs on carry trades, and there are other interesting products. We talked about the tail risk. Many of our products have tail risk protection, which can be very important in this market. Especially Mike Green has talked about the structure of the market, the passive investing. It brings a lot of systemic risk. When the a lot of consensus related trading, when the market is going, everybody wants to buy, and market is selling, everybody wants to sell at the same time. So that's why it's important to have the right amount of risk in your portfolio, have the good risk, keep the good risk in the portfolio, and eliminate the bad risk. A lot of good stuff, blogs and case studies on our website. Check out simplify.us.
Absolutely. And any other closing thoughts?
That's it. I wish somehow India finds a way to be in the final of the Asia Cup and then the World
Cup. Awesome. No, I completely agree with that thought. And on that note, Shailesh, thank you so much for being on the podcast. It was awesome talking to you.
Okay, thanks, Sri. Thanks for the invitation.